In the investment world today, everyone is looking for the next NVIDIA. Everyone is obsessed with the chips, the algorithms, and the software. But there is a fundamental truth that the market is only just beginning to fully appreciate. AI does not run on code alone. It runs on electricity. Massive, unprecedented amounts of electricity. Today, we're going to talk about the company that builds the backbone of this new economy. A company that has quietly transformed itself from an old-school industrial manufacturer into a high-tech power management giant. That company is Eaton Corporation, ticker symbol ETN. We have analyzed their financial journey over the last 5 years from the foundational shifts in their 2020 and 2021 annual reports to the explosive growth revealed in their latest Q1, Q2, and Q3 2025 Analyst Presentations. This is a story about the electrification of everything and why Eaton might be the most important stock for the next decade of infrastructure growth. To understand where Eaton is going, we first need to look at where it came from. Looking back at the annual reports from 2020 to 2022, we see a company in transition. Eaton was historically known for vehicle hydraulics and mechanical power. But the management made a bold decision. They divested low-growth, cyclical businesses like hydraulics and doubled down on intelligent power management. By the 2023 and 2024 annual reports, the vision became clear. They positioned themselves at the intersection of secular megatrends, sustainability, digitalization, and the energy transition. They weren't just selling breakers and switchgear anymore. They were selling the software and hardware needed to manage a complex renewable heavy grid. This strategic pivot raised their margins and reduced their cyclicality, setting the stage for the breakout performance we are seeing in 2025. Why is Eaton trading at a premium today? Based on our analysis of their recent filings, it comes down to 3 specific growth engines. First, and most importantly, data centers and AI. Generative AI requires racks of servers that consume 10 times the power of traditional servers. In the Q2 and Q3 2025 presentations, Eaton highlighted record backlogs. Why? Because you cannot build a data center without power distribution units, uninterrupted power supplies, UPS, and thermal management systems. Eaton is one of the few companies with a scale to supply the Hyperscalers companies like Microsoft, Google, and Amazon. Second, the energy transition and grid modernization. The electrical grid in North America and Europe is old. It was built for a one-way flow of power from coal plants to homes. Today, we have solar panels on roofs, wind farms offshore, and EVs plugging in at night. This creates chaos on the grid. Eaton provides the smart hardware that stabilizes this chaos. In their 2024 report, they emphasize their role in home as a grid, allowing homes to not just consume power, but store and sell it. Third, reindustrialization. Government incentives like the CHIPS Act and the Inflation Reduction Act in the US are bringing manufacturing back home. Building a semiconductor fab or an EV battery plant requires massive electrical infrastructure. Eaton is the primary beneficiary of this construction boom. Now let's look at the hard numbers from the 2025 fiscal year. We have the Q1, Q2, and Q3 2025 analyst decks in front of us. The narrative here is margin expansion. In the first quarter of 2025, Eaton raised its full-year guidance, driven by strong organic growth. By the second quarter, they reported record segment margins. This is critical. It means they are not just selling more products. They are selling higher value products and managing their costs effectively. In the third quarter of 2025, the trend continued. Organic sales growth remained robust, particularly in the Electrical Americas segment. This segment is the crown jewel, directly capturing the data center and manufacturing demand. We also noticed a significant increase in their backlog. Backlog represents orders that are signed but not yet delivered. A growing backlog gives investors visibility. It means Eaton has revenue secured for years into the future, protecting them from short-term economic dips. Is the stock too expensive? Eaton is no longer valued like a rusty industrial stock. It is being re-rated as a secular growth compounder. The 2025 financials show strong free cash flow generation. They are using this cash to pay a growing dividend and buy back shares, continuing a trend we saw in the 2021 to 2024 annual reports. However, risks remain. The supply chain is still complex. Finding enough skilled labor to install this equipment is a bottleneck. And if the global economy enters a severe recession, even secular trends can face headwinds. But Eaton's diverse portfolio spanning aerospace to electrical offers a hedge that pure-play tech stocks do not have. So what is the verdict? Eaton is playing the long game. They are building the infrastructure for the next 100 years. Whether it is an AI data center, a solar farm, or an electric airplane, Eaton is involved. The transition from 2020 to 2025 proves that their strategy is working. They have successfully pivoted from a cyclical manufacturer to a structural growth leader. For investors looking for exposure to the AI and energy boom without the volatility of chip stocks, Eaton represents the pick and shovel play of the 21st century.